Looks like we're going to our next guest. Let's go straight to Harry Watt, Harry Watt from Shaw and Partners, who's standing by via Skype. Sorry about that mumble-jumbled introduction. Harry, good to have you back in the program. The wealth management sector has got a lot of interest, including from M&A space in recent times. I want to go and kick off Magellan today. Really interesting to go and see net outflows, albeit it's a very small, again reported last month. What did you make of it?
Good morning, David. Yeah, about 800 million of net outflows for Magellan. It is up on January's number. I think they had about 500 million out in January, but it's significantly down on sort of the 2 billion plus outflow numbers we saw at the back end of last year. We saw consecutive $2.5 billion net outflows for Magellan in I think it was October and September. So it is starting to ease a little bit, but when you put it in perspective, $800 million out the door for Magellan, that's about 17% of their fund. So it's not really slowing down as probably the numbers suggest, I would say, David. Magellan's an interesting beast.
Okay.
It's certainly cheap, but it'll be cheap if they can turn these fund flows around. So if they can improve on those numbers, it will prove to be cheap. We've already seen some sort of players out there, some other fund managers out there talk that they may have a play at Magellan if it gets cheaper. I think that'll be a very interesting deal if that does come to fruition, but I think we're a long way away from that, and we're probably still a little bit of a ways away from seeing value in Magellan down here, sub $9 at the moment, David.
Okay, so it's cheap for a reason until proven otherwise when it comes to its outlook as well. And that one-year chart doesn't really tell the full story as well. It has been a lot further decline rather than just that one-year chart. When you look across the space, what are some of the names that stand out as being the ones that you want to be invested in given this point of the cycle?
Yeah, well, it's hard to really be invested in fund managers at the moment. I think if you have a look at the market, that everyone's still really concerned with where the Aussie market and the US market, international equity markets are going to go. I think you need to have a diversified player for one, and you need to have someone with balance sheet strength. And I think we've got that in Regal Partners, RPL's the ticker. For these guys, they're small enough and nimble enough that they can add alpha. They've proven that in their performance. Their performance numbers have been really good. They've got a brand recognition that's building in Australia, particularly the Australian market, where people are starting to recognise Regal as the forefront of where fund managers go from here, and they've got really significant cash on their balance sheet. So I think if there's any more tie-ups, if there's any more deals to be done in the fund managers, following on from the Perpetual Pendal deal we saw that completed earlier this year, I think Regal will be in the thick of that. Moving forward, I think their flow numbers are elite at the moment too. So that's one we really like. We would like Pinnacle as well. It's a bit of a choppier play. We sold them not so long ago for a profit, good profit in Pinnacle. But I think if we see a bit more confidence in the market going higher, Pinnacle's one we could be invested in as well. High beta play on that market. But for the moment, given where we are in the cycle, Regal Partners is our pick here and now, David.
Okay. All right. Well, you mentioned Pendal, certainly swallowed up by Perpetual. No, a few months back now. So we've got a little bit of sight as to how that deal has progressed when it comes to synergies within the corporation. What do you make of it so far? How's it going from a grading perspective?
Well, Perpetual came out with their half-year result and didn't really give a lot of detail into how that one's performing at the moment. Market was a little bit disappointed in Perpetual's result. I think costs were up a little bit. And they've got a fair bit of leverage on their balance sheet, even post this deal, post this tie-up with Pendal. They've still got a couple of holes if you look at what their suite of funds are. So there's still a couple of private market holes that they could fill. Whether they have to go out and spend some more money and fill those gaps remains to be seen. We'll be interested to see what they do there. If they try and do that organically, it'll be a long build-up for Perpetual. But all in all, I think the tie-up's a smart move for the two names here. I think moving forward, they will do well. I'm just really disappointed to see that there wasn't a lot of confidence, not a lot of commentary around how that's progressing at the half-year result. I want to see costs strip out pretty meaningfully in this deal to make this one worthwhile. We do like Perpetual. We own that in the income portfolio that we manage as well. So we do see some light at the end of the tunnel in terms of fund flows and in terms of dividends and distributions for shareholders as well. So it'll just be interesting to see. It'll all sort of rely on this third quarter update we'll get next month to just get a bit more detail on how that Pendal tie-up's going with Perpetual.
All right, penciling that into the diary. That will be a cracker to go and keep a close eye and see how things are progressing there. Just to finish off, Harry, when it comes to wealth managers more broadly, do you expect to go and see more consolidation across the sector, given the advent of EFTs, active ETFs, where you've got the fees structure is so much less than what you're paying with fund managers?
I'd certainly do see some more tie-ups. I don't think this will be the last one here. I think moving forward, I think fund managers will want to have a really broad suite of funds that they can offer, and that will leverage into their distribution models and how they can get those funds out and sell to institutional and retail investors. That'll be really key. So really drawing down on that cost base and getting a bit of leverage there in the back office staff as well will be important for how fund managers go moving forward. We've seen funds, ETFs, like you say, that they're really undercutting these funds, and funds will have to follow. We've started to see a move across the board on a few of the bigger names. Magellan being one of them. They've had to cut their funds. They were sort of the market detractor there. They were the higher fund fees in terms of what's out there in the Australian market. So they've had to move. We'll probably see other fund managers move lower as well. And to offset, they'll need to cut their cost base, and you do that by sort of scaling up and reducing the cost burden that back office and that distribution model has on the business, David.